Good morning, everyone, and welcome to the Daily Hunt for Multibaggers. It's Wednesday, November 26th, 2025. We've got a busy show for you today.
Absolutely, Ethan. We've analyzed a significant volume of social media discussions and financial data collected yesterday, November 25th.
Yeah, a lot of buzz out there. We flagged a good number of different stocks, from tech giants dominating the AI space to some more speculative plays. The overall market sentiment we saw was quite polarized, some very strong bullish conviction, but also some serious concerns about valuation and risk.
Precisely. High hopes mixed with fundamental red flags in places. It's going to be an interesting hunt today.
All right, let's dive right into our first candidate, Nebius Group, NBIS. The user sentiment we picked up on NBIS was overwhelmingly bullish, even despite some personal losses being discussed. People are really excited about their demand and capacity, with some even calling out contracts with Microsoft and Meta. The revenue growth is a staggering 355% year over year, which, really underpins that long-term potential. This one's been in our stay away category recently.
Well, Ethan, while that revenue growth is certainly impressive, the KPIs tell a more cautious story. NBIS is operating with negative earnings per share and a negative operating margin. Despite the high demand, they're losing significant money on core operations. Plus, a debt-to-equity ratio of nearly 95% indicates substantial financial strain. Jim Cramer even called it too speculative. While users are discussing future development, these current financials don't support a strong investment right now. So, despite the optimism, our AI-generated insights suggest NBIS should remain in the stay-away category.
Got it. So for NBIS, it's a stay away for today. Next up, Meta Platforms, META. There's been a ton of buzz around Meta, with some users making huge bets, believing the bottom is in. They're highlighting Meta's perceived attractive valuation compared to other big tech and its strong revenue growth, which sits at over 26%. And, their massive AI investments are definitely a long-term catalyst. It remained a buy for us yesterday.
I hear you, Ethan, and the 26% revenue growth and impressive profit margins are certainly strong. However, we've also seen a lot of skepticism. Some users are calling recent gains luck, not a sustainable trend. Analysts are flagging rising AI and cloud costs, which could compress those margins, and there are even ongoing legal risks with a lawsuit regarding teen mental health. While Meta is investing heavily in AI, which could improve future KPIs, the immediate concerns and the significant volatility warrants careful consideration. It makes me a bit wary.
I get the caution, Brooke, but with those robust profit margins and strategic AI moves, I think Meta's well positioned for continued growth, even with some headwinds. Our analysis still points to a strong underlying business, so for Meta, we're classifying it as a buy. Moving on to Advanced Micro Devices, AMD. We previously had AMD in the cautious buy territory. They've shown good revenue growth in the past.
Yes, Ethan, but the sentiment around AMD has turned distinctly bearish. News reports are showing their stock plunging by 9% because Meta is now considering Google's AI chips. That's a huge competitive threat. AMD's price-to-earnings ratio is an extremely high 107, indicating massive future growth is already priced in, and they also carry a very high debt-to-equity ratio. These are critical risks if their market share in AI chips is eroded.
That's tough news for AMD for sure. The competitive landscape is clearly shifting. For AMD, that's a stay away. Now, let's talk about Dell Technologies Inc., DEL. On the surface, the news is very positive, Ethan. Strong Q3 earnings, upbeat guidance, and high demand for AI servers. This is their first time on our radar.
Exactly. It sounds like they're really capitalizing on the AI boom, showing good revenue growth. That kind of demand can really drive a company forward.
It could, Ethan, but there's a huge red flag waving here. Dell has a significantly negative price-to-book ratio of minus 30.73. That means their liabilities exceed their assets, indicating negative shareholder equity. While the market might be focused on the AI server demand right now, this fundamental financial fragility is a serious concern, despite their current profitability. It suggests significant underlying risk. Wow, that's a big one, Brooke. You can't ignore negative shareholder equity. For Dell, despite the good news, it's a stay away. All right, let's discuss HP. HP Helmrich & Payne Incorporation. This is a first-time appearance for them. Analyst upgrades from Goldman Sachs and Zephyrin, coupled with a generally positive energy sector, suggest some good momentum here.
Hold on, Ethan. We need to clarify something crucial for our listeners. The social media comments we're seeing are overwhelmingly negative, criticizing HP Inc., the PC and printer company. Users are calling their products junk and expressing frustration. However, the KPIs and news we have are for Helmrich & Payne, an energy company. It's important not to mix them up.
Good catch, Brooke. That's a vital distinction. So for Helmrich & Payne, what do those KPIs tell us, apart from the positive analyst ratings?
Well, for Helmrich & Payne, despite the analyst optimism, the company is actually operating at a loss, with negative earnings per share and a negative net profit margin. They also have a very high debt-to-equity ratio, indicating heavy reliance on debt financing. While the energy sector might be doing well, these fundamental profitability issues and high leverage are significant risks for Helmrich & Payne.
Thanks for clearing that up, Brooke. Given the underlying financial metrics, even with the positive analyst sentiment, for HP, Helmrich & Payne, it's a stay away. Up next, Palantir Technologies, PLTR. This one has a lot of growth-oriented investors watching it. It's shown robust revenue growth of almost 63% and really strong profit margins. Jim Cramer even endorsed it recently. It's been in our stay away category for a while now, so maybe this is a chance for an upgrade.
Ethan, that growth is indeed strong, but the overall sentiment from users is quite bearish, expressing strong concerns about overvaluation. Palantir's price-to-earnings ratio is an astonishing 371, and its price-to-book is nearly 60. This screams AI bubble to many. There are also concerns about share dilution. While their margins are good, that valuation is pricing in an extraordinary amount of future growth that may not materialize, especially with a high debt-to-equity also on the books.
That PE is certainly a lot to swallow. Given those valuation concerns, for PLTR, it's a stay away for us today. Now, let's talk about Nvidia Corporation, NVDA. The social media is absolutely buzzing about Nvidia. Their Q3 earnings were phenomenal. Record sales, 62% year over year, and strong Q4 guidance. CEO Jensen Huang even said Blackwell chip sales are phenomenal, and cloud GPUs are completely sold out. Users see them as the undisputed leader in the AI ecosystem. We had it as a stay away yesterday. This is a podcast script with two speakers, Ethan and Brooke.
Ethan, the numbers for Nvidia are undeniably strong. That revenue growth and a staggering 53% net profit margin showcase their dominance. However, their price-to-earnings ratio is still quite high at 44, which implies significant future growth is already expected. We're also seeing some reports of their shares falling due to Meta considering Google-designed AI chips, signaling competitive pressures. While their performance is exceptional, that high debt-to-equity ratio of over 8 means they need to maintain this perfect execution.
You know, Brooke, even with the competition, Nvidia's position in AI is just too strong right now. The demand is insatiable, and their ecosystem is robust. I think they can maintain that exceptional execution. For NVDA, it's a definite buy today. And finally, Apple Inc., AAPL. We had Apple as a speculative gamble just yesterday, but now it looks like it's experiencing a top-of-range breakout with massive volume. Wall Street is broadly bullish, and Apple is increasingly being mentioned as a key player in the AI revolution. It's already hitting new record levels.
That's great technical momentum, Ethan, and Apple's massive market cap and strong profit margins are undeniable strengths. But we have to acknowledge the high price-to-earnings ratio of over 37. There are also reports of rare job cuts, a major patent verdict against them, and an antitrust probe in Poland. While Apple is a giant and can weather these storms, these are not insignificant risks that could impact future financials, so vigilance on cost management and legal developments is key.
I think Apple's brand strength and ongoing innovation, especially in AI, position them well for the long term. The market seems to be shaking off those smaller headwinds. For AAPL, we're classifying it as a buy.
Last but not least, Strategy Inc., MSTR. We had this in our speculative gamble yesterday. The discussions are intense, with many users directly calling its business model a Ponzi scheme because it funds Bitcoin acquisitions through new preferred stock without selling any Bitcoin.
Yeah, but some users are seeing the recent massive stock drop as a contrarian indicator, viewing it as oversold. They're pointing to potential Bitcoin tailwinds and believe it's an extraordinary opportunity to buy the dip, especially with its price-to-book ratio below 1.
Ethan, that opportunity comes with extreme risk. MSTR has an alarmingly high debt-to-equity ratio of over 14, indicating massive financial leverage. Its beta is over 3, meaning it's incredibly volatile. Plus, MSCI is considering removing MSTR from its indices due to its Bitcoin exposure, which could trigger huge institutional selling. Jim Cramer even said the stock cannot handle the truth. Regardless of any contrarian optimism, the fundamental risks are just too high.
Those are some pretty serious red flags, Brooke. For MSTR, we have to classify it as a stay away. All right, let's quickly recap our list for deeper analysis today. Investigate as buy, Apple Inc., AAPL, Meta Platforms Inc., META, and Nvidia Corporation, NVDA. Investigate as cautious buy, none. Investigate as speculative gamble, Strategy Inc., MSTR.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses. The market is a wild place, and knowledge is your best asset.
That's right. Thank you for joining us on the Daily Hunt for Multibaggers. We'll be back tomorrow with more AI-generated insights into the market. Until then, happy hunting!